Okay, welcome to the section where we'll be discussing extensively on how do we proceed in accounting for investment in associate and joint venture. And in addition to this discussion, we also more or less discussed on joint arrangements with respect to IFRS 11. Welcome to this session, and this session will more or less wrap up some of the discussions we've had severally on sections that covers the consolidation of the statement of financial position of the parent and subsidiary, the consolidation of the statement of profit or loss and other comprehensive income of the subsidiary with the parent, and likewise the consolidation of the statement of changes in equity of both the parent and the subsidiary. Now we'll be discussing extensively on the requirements not to consolidate our investments in which the investee qualify as an associate or as a joint venture. Rather, we are required to use a methodology totally different from consolidation, where we account as a line item our investment and our returns from such investment in the books of the group from the perspective of the associates and the joint venture. And these are all what we're going to discuss in the course of this session. Okay, and before we more or less dabble into this session, I want somebody to more or less read an excerpt from the introduction so that we can know all areas to which we'll focus on in the course of the discussion on this chapter. Over to anyone who volunteers to read.
Okay, I will read. Chapter 11, Investment in Associates and Joint Ventures. Introduction. This chapter will focus on the principles for accounting for other forms of intercorporate investments other than investment in financial assets. And these principles differ from the acquisition method of accounting for a business combination and the dynamics of consolidation and its techniques. The first phase of the chapter will focus on the aspect that tends to provide guidance to the readers in understanding what constitutes an investment in an associate and also on its initial accounting vis-a-vis its subsequent accounting. In the second phase of this chapter, a similar approach will be adopted to explaining the dynamics of identifying and recognizing investment in joint ventures and how such differs from a joint operations investment. A brief discussion of these requirements and propositions of IFRS 11 joint arrangements will be considered so as to allow the readers to understand the clear-cut differences between the two forms of joint arrangements. Within the context of this chapter, it will be evident that the accounts of an associate and that of a joint venture cannot be consolidated, but rather a common accounting methodology called equity method will be adopted in line with the requirement of IAS 28 to account for both investments, that is investment in associates and joint ventures. The method equally accommodates necessary adjustments that may involve elimination of unrealized profits, impairment losses, and dividend received from investment in associates or joint ventures.
Okay. Thank you very much. These are what we'll likely come across or discuss with respect to this. Okay, and our discussion will go as follows. How does IAS 28 define an associate? From the perspective of IAS 28, an associate exists being an investee where an investor exerts significant influence on such an entity. The entity to which significant influence is exerted upon by another who is the investor will be considered an associate. Now, peradventure, the standard says as follows: an associate is an entity which may include unincorporated entity, such as partnership, over which an investor exerts significant influence. And neither does that influence give rise to control to make it a subsidiary, nor a joint control to make it a joint venture. Therefore, an associate in simple terms is an investee entity to which an investor exerts significant influence. In next order, we need to cross this to say, what then is a significant influence? Significant influence in this regard could be viewed from two perspectives. I'll start from the quantitative perspective, which is threshold. The quantitative perspective views significant influence from the perspective where an investor, which is an entity, having voting rights in an investee that ranges between 20% and 50% of such a voting right in that investee entity. And in that light, we say such an investor holds significant influence in the investee. But this is not always the case as we move on. But this is usually the case in practice. There are exceptions to this rule, and there are two sides to the exception. The first side to the exception is that having stake in the investee that ranges between 20% and 50% of the voting power may constitute control, which is higher in rank to significant influence. And I think in our discussion in earlier chapter, which you can go back to watch the video, when we are discussing control and subsidiary with respect to consolidation, we also identified that there are situations where an investor may have less than half of the voting rights and it exerts control. Which is what we're emphasizing here, that sometimes holding between 20 and 50 might equally give control, which is beyond significant influence. But what matters now is to focus much more on the qualitative attributes of what make up a significant influence. The second perspective to it is that even with less than 20% stake in an investee entity, an investor may still hold significant influence. What does that signify? If you owe 10%, you owe 50%, it's still possible to have significant influence over the affairs which borders on the financial and operating policies of the investee. And we are going to look at those instances. But what that matters is not to rely solely on the quantitative threshold, but also focus on the qualitative threshold. Now, what are the qualitative attributes that can presuppose that significant influence is exerted by an investor in an investee entity? IAS 28 comes up with this following practical demonstration that there is a significant influence. One of which is that no matter the stake you have, how low it might be, below 20%, once you have at least one member on the board as a result of your stake in that entity, and you have at least one member in the board of such an entity, it will be deemed that since you have some level of involvement in the decision making, no matter how little it is, in such an investee entity, such is enough to give you significant influence. Another perspective to which the standard views significant influence is no matter the medium or manner in which you start to participate in the policy-making process of that entity, it means you are involved deeply in its financial and operating policies. And therefore, in that instance, you have a significant influence, regardless of your threshold. Or a situation whereby your stake in the entity guarantees you a position such that you enter into material transactions with the entity as an investor. In that situation, that also presupposes that such gives significant influence. Another aspect is if peradventure your stake in that entity guarantees or qualifies you to nominate key management personnel, such as nominating the CFO, giving slots for CEO, giving slots for CTO, or giving slots for those that might be involved in the day-to-day managerial direction of such an entity, that also may signify that you have a significant influence. And lastly, when such an influence or such an involvement in the affairs of the investee entity gives you access to essential, technical, privileged information about the affairs of the entity, in that light, it will be considered that you have a significant influence. The question then is, significant influence can be viewed directly from holding between 20% and 50% of the voting power or rights in the investee, or indirectly can be from the perspective of any of these qualitative attributes. And that is very key in our discussion. Okay, therefore, what is a significant influence? A significant influence in this light is the power the investor has over the investee with respect to participating in the investee's affairs, which is with respect to participating in the investee's operating and financial policies of the investee. In that light, we say you exert some kind of influence. And doing so now make us to see the investee to qualify as an associate. The investee qualifies as what? An associate. Now, having qualified as an associate, the next hurdle we need to cross is to ask ourselves a simple question. How then do we account for our stake in an associate? Are we going to account for it in similar vein as we have accounted for financial instruments in terms of financial assets, since it's an equity investment? Or we account for it in the vein to which we have consolidated our equity investments in a subsidiary? Or at what basis do we adopt to accounting for our equity investment in an investee considered to be our associate? That is the next hurdle we need to cross. But before crossing the hurdle, we will divert our attention towards discussing on something that we need to discuss so that we can marry those two things together in order to forge ahead. But before doing that, I'll just give you a tip. The tip is that investment in an associate primarily will be accounted for using equity methodology. Using what? Equity methodology, which is simply put as equity methods. But before we more or less focus on this, we will simply go towards having slight discussion by introducing the requirement of IFRS 11 with respect to joint arrangement. The essence of doing so is that IAS 28 does not deal with associates alone, but deals with how do you account for your investment in an associate and likewise your interest in a joint venture. The question then is, for us to appreciate what a joint venture is, we need to have understanding of the kind of arrangements that could give rise to a joint venture and what alternative can such an arrangement give rise to, if not a joint venture. And that is why the chapter 12 of my book, which is titled Contemporaneous Accounting for Business Combination and Group Accounts, will give us a clue towards answering this question. Now, in chapter 12, we'll be discussing, sorry, in chapter 13, I guess. Okay, I think it's still within chapter 11. Okay, we'll look at this. Okay, joint arrangements, IFRS 11. Now, joint arrangement is usually an arrangement with two or more interested parties having common objective, even though sometimes they are competitors in the same line of business, but they have common purpose to which they believe by pulling resources together, they can achieve common goals. Practical example of such is where you have companies operating in upstream oil and gas, where they might jointly develop or construct a pipeline. They might jointly take risk on oil licensing, whether be it a joint venture or joint operating agreement, or be it a production sharing contracts and some other things, where they put resources together to share the risk and the reward attributable to such an arrangement. This is what we mean by joint arrangement in its literary sense. It requires the pooling of resources together towards achieving common objective and purpose. Okay, and we'll discuss that extensively. Okay, and that is that. But before I break it down further and shaping the narrative for us to have a better understanding, I want somebody to volunteer, as usual, to make some expression out of this. And from there, we'll move on. And I hope you have a better network today.
Yeah. Yes.
Okay. Yeah, can you assist us?
Okay. Joint arrangement, IFRS 11. Joint arrangement is an agreement of which two or more parties have joint control. The joint arrangement has the following characteristics. First, the parties are bound by a contractual arrangement. And secondly, the contractual arrangement gives two or more of these parties joint control of the arrangement. A joint arrangement is either a joint operation or a joint venture. Types of joint arrangements. Joint arrangements are either joint operations or joint ventures. First, a joint operation is a joint agreement whereby the parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities relating to the arrangement. Those parties are called joint operators. Second, a joint venture is a joint arrangement whereby the parties that have joint control of the agreement have right to the net assets of the arrangement. Those parties are called joint ventures. Classifying joint arrangements. The classification of a joint agreement as a joint operation or a joint venture depends upon the rights and obligations of the parties to the agreement. An entity determines the type of joint agreement in which it is involved by considering the structure and form of the agreement, the terms agreed by the parties in the contractual agreement, and other facts and circumstances. Regardless of the purpose, structure, or form of the agreement, the classification of joint agreements depends upon the parties' rights and obligations arising from the agreement. A joint agreement in which the assets and liabilities relating to the agreement are held in a separate vehicle can be either a joint venture or a joint operation. A joint agreement that is not structured through a separate vehicle is a joint operation. In such cases, the contractual agreement established the parties' rights to the assets and obligations for the liabilities relating to the agreement, and the parties' rights to the corresponding revenues and obligations for the corresponding expenses. Accounting by parties to joint agreement. Can you scroll up, please? Accounting by parties to a joint agreement. Joint operations. A joint operator recognizes in relation to its interest in a joint operation. First, its assets, including its share of any asset held jointly. Second, its liabilities, including its share of liabilities incurred jointly. Third, its revenue from the sale of its share of the output of the joint operation. Fourth, its share of the revenue from the sale of the output by the joint operation. And lastly, its expenses, including its share of any expenses incurred jointly. Should I take this up? Okay.
Okay. Continue.
All right. A joint operator accounts for the assets, liabilities, revenue, and expenses relating to its involvement in a joint operation in accordance with the relevant IFRS. The acquirer of an interest in a joint operation in which the activity constitutes a business, which as defined in IFRS 3 business combination, is required to apply all of the principles on business combination accounting in IFRS 3 and other IFRS, with the exception of those principles that conflict with the guidance of IFRS 11. These requirements apply both to the initial acquisition of an interest in a joint operation and the acquisition of an additional interest in a joint operation. In the latter case, previously held interests are not measured. Technical notes. The requirements above were introduced by accounting for acquisition of interest in a joint operations, which applies to annual periods beginning on or after 1st January 2016 on a prospective basis to acquisition of interest in a joint operation occurring from the beginning of the first period in which the amendments are applied. A party that participates in but does not have joint control of a joint operation shall also account for its interest in the arrangement of accordance in accordance with the above if that party has rights to the assets and obligations for the liabilities relating to the joint operation. Joint ventures. A joint venture recognizes its interest in a joint venture as an investment and shall account for that investment using the equity method in accordance with IAS 28, that is investment in associates and joint ventures, unless the entity is exempted from applying the equity method as specified in the standard. A party that participates in but does not have joint control of a joint venture accounts for its interest in the arrangement in accordance with IFRS 9 financial instrument or IAS 39 financial instruments if it has not early adopted IFRS 9. Unless it has significant influence over the joint venture, in which case it accounts for it in accordance with IAS 28 as amended in 2011. Separate financial statement. The accounting for joint agreement in an entity's separate financial statement depends on the involvement of the entity in that joint agreement and the type of the joint agreement. First, if the entity is a joint operator or joint venture, it shall account for its interest in 1. A joint operation in accordance with IFRS 11, that is joint agreement, and secondly, a joint venture in accordance with IAS 27, separate financial statements. B, if the entity is a party to participate in but does not have joint control of a joint agreement, shall account for its interest in 1. A joint operation in accordance with IFRS 11, which is joint agreement, and 2, a joint venture in accordance with IFRS 9 or IAS 39, unless the entity has significant influence over the joint venture, in which it shall apply IAS 27 as amended in 2011.
Thank you very much. Thank you very much. We'll go back to where we started from. Okay, now what we have come across here is that joint arrangements comes in two forms. One is known as jointly controlled entity, and the other one is known as jointly controlled operation. And in simple terms, it is known as joint operation, which is for the jointly controlled operations, and joint venture for that considered jointly controlled entities. What is the thin line between the two? The most critical consideration in separating the two, having understood that they both represent joint arrangement, is issue of shell. The shell is more or less like the abode or the home that shelter what kind of activity goes on within the joint arrangement. If a joint arrangement does not necessarily create a separate entity to manage such an arrangement, such may be considered as a joint operation. Otherwise, it will be considered as a joint venture. Now, let me break it down. If two companies, whether they are in the same line of business or not, come together for common purpose and objective to pool resources together in order to jointly operate an asset, or jointly operate certain activities which would benefit both parties. Such activity will be considered joint operation agreement. And therefore, that will have created a joint operation. A typical example of such is when two upstream entities come together to develop a field together by way of arrangement that has been agreed. In such an instance, what has been created is a joint operation because each operator, or as the case may be, or each interest holder will be entitled to his own portion of the operation based on the agreement. Another typical example is this. Imagine in the early days of the telecommunication industry in Nigeria, the days of introduction of GSM. And the operating companies during those days co-opete. The word co-opete means from the word co-opetition. Co-opete means that even though they are competitors, but there are rooms to which they can have common ground to cooperate. And one of those common grounds to cooperate is that they jointly manage the marks that warehouses their radar, their router, or what gives the wave that in which we with mobile phone communicate with. Now, what then you need to do is that instead of MTN, Airtel, Glo, 9 Mobile having different masks within the same vicinity, they can jointly host a mask in which they put their individual devices and jointly control those masks by way of contributing to it by way of assets, managing the affairs of the masks, and any costs associated with it are shared in the ratio that has been agreed based on certain parameters. And this is what can be done in order to cooperate. Now, that is a practical example of a joint operation. Okay, and later on in the course of this discussion, we'll more or less delve into what is competition in its real sense. Because when you have a better understanding of competition, you see where joint venture or joint operation emanate from, which is the joint arrangement. Now, that is that. But on the other side is the joint venture. Joint venture usually come up by way of creating a vehicle, which I called earlier on a shell. Creating a vehicle that will drive the common purpose, which will be separate from the individual interest holders in the joint arrangement. And I'll use practical example to illustrate that so that we can have better understanding rather than looking at it from the theoretical perspective. How many of us know about NLNG, Nigerian Liquefied Natural Gas? Who knows about NLNG? Who can tell me little about NLNG and how NLNG is given birth to and what purpose does it tend to serve? The floor is open. NLNG is Nigerian Liquefied Natural Gas. I wait your contribution, guys. I wait your contribution. Nobody's talking. Anyone?
The only thing I know is just the full name that you've just mentioned. So I don't really know anything about it.
Okay, who else? Who else? Madam Uwanko. Bashir.
Okay.
Yes, I'm awaiting you guys' contribution. Okay. See what I've done for you guys. Now you can go to their sites, and who can start with this? Who are we, NLNG? Who are we? Who can read it out?
Okay. Who are we?
Yes.
Okay. Nigeria NLNG Limited is a major player in the global NLNG business.
What happened to the network? So there's something. Okay, continue.
Okay. Nigeria LNG Limited is a major player in the global LNG business. LNG was incorporated as a limited liability company on May 17, 1989 to harness Nigerian vast natural gas resources and produce liquefied natural gas and natural gas liquids.
Okay, thank you. Who are the shareholders?
Shareholders. NLNG is owned by 4 shareholders, namely the federal government of Nigeria, represented by NNPC with 49%, Shell Gas BV with 25.6%, Total Gas Electricite Holdings France with 15%, and any international NANVS with 10.4%.
Okay. Now, NLNG, as it is a creation of a joint arrangement between these 4 parties. The NNPC, which represents the federal government interest, Shell for short, Total for short, and Eni for short. Okay, Shell, you guys know that Shell is from Netherlands, or what you call Holland. Total is from France, and Eni, I think, is from Italy. Okay, and NNPC is Nigeria. And it's a joint arrangement that created the vehicle known as NLNG. And NLNG is the most profound joint venture in Nigeria. And therefore, NLNG is a typical and classical example of a joint venture. Now, what is the uniqueness is that it's similar to joint operation, but the whole difference here is that instead of those 4 entities to manage the gas field together by way of operation, rather, they created such activity by way of business. And that business is warehoused through a vehicle they call NLNG. Now, NLNG, as opposed to what we'll have done by having a single pipeline which serves the purpose of oil and gas company, is that this is going to function as a separate legal entity from the investors. And it operates on its own as a legal entity, in which every of the interest holder in the joint arrangement hold equity interest in it. Unlike joint operation, they don't own equity interest. What they have as interest is that they have interest in the assets, in the operation, in the resources contributed. And all of these terms play a role in the accounting. Remember, having stake in an asset or resources of an operation is different from having stake by way of equity in the net asset of that business. And that's what I'm emphasizing here, which speaks to the fact that a joint operation does not operate as an entity. It operates as an extension of the activities of the interest holders, which you call the operators. Whereas a joint venture operates as a separate legal entity and a business alike, away from the investors or the interest holder in such a joint arrangement. And that is how I can demystify the difference between joint operation and joint venture. But both is the creation of the instrumentality of joint arrangements. And that is why IFRS 11 defines joint arrangement in its practical sense as an arrangement or a form of agreement that is ensued between 2 or more parties that brings about joint control. Joint control about what? Is it joint control over operations or joint control over the business as well housed by a separate legal entity? And that is that. Okay, and one of those key qualities of a joint arrangement is that one, there is a mutual agreement in which the parties are bound by that such contractual arrangement. The mutual agreement is such that no party has control over others regardless of your stake in that entity or in that operation, because by your mutual agreement, it is more or less situated and written or implied that decisions will be collectively reached and must be unanimous, and not decision on the basis that NNPC has the largest stake, therefore it controls others, or it takes decision that the others might not be in tune with. No, the question is that in a joint arrangement, the express agreement, and in real situation, the implied agreement is such that there's a mutual consent that must be sought at every point in time. This is not the issue of majority against minority. There's nothing like majority, neither is there anything like what? Minority. Or because you've come together to more or less surrender your stake for mutual contractual arrangements. And that is that. And also, this contractual arrangement must give rise to joint control. Without joint control, there's no joint arrangement, which means we'll be falling back on the fact that, okay, such an arrangement will it give rise to control which says one is subsidiary, one is parent, or give rise to significant influence where one is investor, one is associate. If there's no joint control, there can never be joint arrangement, regardless of how you structured it. And that is what the focus of our discussion is all about. And all of what Anne read is what I've tried to demystify and explain in this term that will make us have a better understanding of joint arrangement. The question then is, how does this influence the accounting for joint operation separately from the accounting from joint venture? Because your stake, okay, there's a question. Shegun, over to you.
Okay, sir. Yeah, my question is that what if the joint operation to be performed will not last over an accounting period? Maybe it's just like one-off service between two partners. For instance, now maybe we just combine resources to execute a particular project, which might not really last for maybe 4 or 5 months. Do we still call that a joint venture or joint operation?
The first question we ask or try to answer is, was there a joint arrangement? You understand? It's only when there's a joint arrangement that you now ask yourself by the substance and the nature of the arrangement to say, is it a joint operation or a joint venture? Now remember, I emphasized something about joint venture being a business. And from the definition of a business, there's input, there's process, and there's output. And even from the commercial terms of definition of a business is seen to operate in the foreseeable future. Therefore, if it's something that you carry on only for 5 months, 6 months, 1 year, I don't think it can form a basis to classify it as a joint venture. Rather, it will be joint operation, which means your interest is not in the equity. Well, such does not create equity since it's not a business. Rather, your interest is in the assets or resources attributable to such an arrangement. Does that make sense?
Yes, sir. And secondly, sir, how about firm of professionals, like maybe audit firms or other ones? You know, this is more or less a partnership business. Do we call it, what kind of joint arrangement is that? Is it joint operation or joint venture?
Usually, such arrangement will be joint operation. Do you get what I'm saying now? Probably when we get towards the understanding of what is coopetition, why do competitors cooperate, and what kind of examples can we give, we further buttress when a joint venture can materialize. And let me give you a clue. A joint venture is much more expected to run on a sustainable basis for a long period of time. That's why people create a vehicle for it. Something like Int'l engine. Do you get what I'm saying now? But that doesn't mean that a joint operation can equally not last as long as that. But I'm just giving you some clues about that. Okay, I don't see what big firms or professional firms can permanently do together that will allow them to create a joint venture. Rather, they can have more of a joint operation. And probably when we look at the scenario with respect to Microsoft and Int'l, we'll see whether it's a joint operation or joint arrangement. We'll also look at other scenarios. We'll look at that. But let's quickly venture into what we call coopetition. Let me share this with us. And okay, can somebody read about coopetition?
Okay, coopetition. What is coopetition? Coopetition is a act of cooperation between competing companies. Businesses that engage in both competition and cooperation are said to be in competition. Certain businesses gain an advantage by using a judicious mixture of cooperation with suppliers, customers, and firms producing complementary or related products. Competition is a type of strategic alliance that is particularly common between software and hardware firms. Key takeaways: competition is the act of cooperation between competing companies by forming a strategic alliance designed to help both companies. Competition includes a mixture of cooperation with suppliers, customers, and firms producing complementary or related products. Competition is common in the technology industry, particularly between software and hardware firms. Understanding competition. Competition is a business ideology taken directly from insights gained from game theory. Competition games are statistical models that consider the ways in which synergy can be created by partnering with competitors. The tactic is thought to be a good business practice between two businesses because it can lead to the expansion of the market and the formation of new business relationships. In this capacity, agreements on standards and developing products across an industry or between two competitors is necessary to implement competition. The competition model. The statistical model determines the benefits of competition and also looks at the allocation of market share between competitors to maximize the market share of leading companies. The model is initially drafted using a diamond shape, which customers, suppliers, competitors, and complementors in each corner. The aim of competition and the model itself is to move the market from zero-sum game, where a single winner takes all, to an environment in which the end result benefits the whole and makes everyone more profitable. The linchpin of the model is understanding the input variables that influence the players within the diamond to compete or cooperate. The understanding leads to knowing which forces will make the players compete and which forces will make them cooperate, and to which capacity. The professors from Harvard and Yale, Adam M. Bradenberger and Barry J. Nilbov, pioneered the idea of competition.
Okay, let's look at example of, can you read about the Microsoft?
What is an example of competition? The authors point to the Microsoft-Intel relationship as one of the best known examples of competition. The demand for Intel chips increases when Microsoft creates more powerful software. Microsoft becomes more valuable when Intel produces faster chips. That is not a win or lose proposition, but rather a win-win.
Thank you. Now let me now play something for you guys.
In the last 2 decades, with the rise of the internet, the business world has changed, and also the whole business playbook has changed. We could break down companies, especially based on the supply side, so how those companies were managing to dominate the whole supply chain and be more efficient, offer products and market those products way more quickly. Then suddenly with the internet, those boundaries actually became more complex to understand. I want to show you one example of this sort of change framework that has been called in the business world competition. And this is a concept where the companies that in theory, some companies that in theory are competitors also sort of cooperate. One example of this is by a company like Netflix and Amazon. If you know how Amazon is structured, you say, why would Amazon compete with Netflix? Well, Amazon has a service which is called Prime, which is primarily a subscription service that is competing with the streaming side of Netflix. So if Amazon is using Prime, at least at the beginning, it experimented with different programs, and Prime was successful in delivering more value to existing Amazon customers by making them repeat customers, and also by pushing more the purchases on the e-commerce platform. So if initially Amazon would produce content just because this would help the platform become more valuable and also make Amazon brand stronger, is this sort of transition where also Amazon Prime is becoming a sort of independent business unit. So here you can see how Amazon Prime is competing with a streaming platform like Netflix, driven both by a subscription service, so both Amazon Prime and the streaming side of Netflix. At the same time though, if you look at the streaming side, as you can imagine, this requires a lot of a strong infrastructure, especially a cloud infrastructure, able to host all the content that we can find on a platform like Netflix. And in this case, the interesting thing is that Netflix is primarily using for its streaming services Amazon AWS, which is the cloud service side of Amazon. Of course, we don't know for how long this will continue, because we can imagine that Netflix itself is experimenting with other cloud infrastructure, just because, for instance, it might fear that Amazon AWS might interfere with the growth of Netflix, as Amazon Prime will become more important as content producing company. So we can imagine this scenario to change. Yet in this case, if you look at Amazon and Netflix, while those companies are competitors in trying to grab, at least like from Amazon Prime and Netflix streaming platforms, while those companies are competing, on the other side, they're also sort of cooperating where, again, the streaming platform of Netflix is using the AWS of Amazon as one of the major clients of the platform. And at the same time, Amazon AWS is also pushing on its developers community to build as much tools available to a streaming platform as Netflix to make sure that it can run its operations as smoothly as possible. So this is a concept of competition, and how the world of strategy is a little bit more complex to understand.
Okay, what are your views now before we forge ahead? Bashir? Bashir? Check me on, say something.
Okay, yes, I didn't really get what he said very clearly, but what I think I got from his message is that there's a kind of mutual competition between Amazon and Netflix, in the sense that Netflix using this open source platform of Amazon, the AWS, but I didn't quite understand what Amazon benefits from Netflix. Though Amazon has the Amazon Prime, but is it that it is connected to the streaming service of Netflix or something? Because I think Amazon streaming is independent of that of Netflix. So that is what I want to understand. It's like Netflix is benefiting from the AWS of Amazon, but what is Amazon getting from Netflix to call it competition?
Amazon is getting paid for that now.
Yes, I know Amazon is getting paid. I understand, but if we call it competition, then it means that there must be like another service that Netflix is offering Amazon, if I'm getting it right.
It's not necessarily that it must be service to service. It might be service to cash consideration or to other things. For example, SAP and Oracle are competitors, but SAP runs on Oracle database.
Okay, I think it's just the same thing. It's just the same thing. Amazon Prime and Netflix, they are competitors, but Netflix runs on Amazon AWS.
Yeah. Similarly, for Google, Google owns Android.
Yeah, Microsoft
platform.
What platform do you call it?
On Android.
Okay.
Android. And Samsung on Android, and Google also have his own phone running on Android. What will we call that?
Okay. I think it's still...
That's also competition.
Yes, but it's risky anyway.
Born out of strategic alliance, which means when you are, not everything comes with its own issue. You understand? In life, competition is a driving force for growth and development. But the way we see competition from this our own world, especially in Nigeria, is totally different. When you see your competitor, you see that person as your pure enemy, that if possible, the person should die. The company should die. But no. If all your competitors are not in existence, you too will not grow, because nothing will be pursuing you to greater heights. Do you get what I'm saying now? Ronaldo and Messi would not have grown to the level they are today if they have not been vigorously competing between themselves. Do you get what I'm saying now? And that's what we are trying to explain. Now, how does this affect the accounting? Accounting for joint operation by each of the operators is very straightforward. Now, it's very straightforward to the extent that each of the operators will account for their own specific assets contributed in their books, and likewise account for their share of the common assets that has been contributed together in their own books. Which means, if, for example, I'm a company, you are a company, and we put resources together, I contributed my own vehicle, you contributed your own computers. Later on, we both decide to build a structure that will accommodate us. Now, I will account for my direct ownership of the motor vehicle in my books, even though it is allocated to the joint operation for use. You also, you account for your laptops, your computers directly in your books, even though it has been committed for use by the joint operation. Now, the portion that we now account for by way of share is the common assets, the building. In the process of the arrangement and committing to building that asset, how much have I contributed will form the percentage I will recognize as my share, and you recognize your own share. If there's any liability jointly owed by the operation, you share it in the proportion that has been agreed, and you recognize that in your individual books as a joint operator. If you have any expense, be it depreciation of assets, be it expense incurred in terms of salary, in terms of operational expenses and etc., utilities, you also share based on what has been agreed. And that share will be recognized in your individual books as your share of a joint operation expense, which is part of your operating expense as an entity. If there are income per se that might have arose from such an operation, as the case may be, you also account for your own share of the income. And that is how you simply account for your stake, your interest in a joint operation. But that will not be said of joint venture. Joint venture by its own principle will be accounted for in similar vein as we are going to be accounting for an associate. That is why we pause on an associate to come here in order to return back to that. And what is it? Joint venture will be treated using equity methodology. For short, equity method. Which then means that we can now go back to where we started from in marrying the accounting for joint venture with that of associates. Does that make sense now? Can you see the relationship where IS 28 is now coming from a perspective of accounting for associate and joint venture in similar manner? Any question? Therefore, what is equity method? Equity method is opposed to a method other than consolidation and other than accounting for your equity stake in line with the requirement of IFRS 9, which is financial assets required to be measured at fair value. Okay, rather, what equity method says is this. I will switch to my workbook. Now, accounting for investments in associates and interests in joint ventures. Now, the method we are using is equity method. And what is equity method trying to infer? Let's say all figures in thousands of Nigerian naira. Now, what equity method is saying is very simple. It's saying that the first point of call is your cost of equity investment in the associates or joint venture. Let's say is 100,000. Okay, now this amount we are talking about initially represents the fair value of the equity investment in the associate or joint venture as at the acquisition date, which is also as the investment date. That is the date in which we obtain Let me show this up so that you can always see it. Okay, sorry, I think I was muted since. Can you hear me now?
Yes, sir.
Okay. Now, what I'm saying is that we are back in this discussion. And what is next for us to do is to, in addition to the cost of investment, which I said it represents the fair value of the equity investment in the associates, or joint venture as at the acquisition date. What is next is for us to add our share of the post-acquisition profits in the associates or deduct our share of post-acquisition loss in the associates. And as I've said earlier, when I was muted, was that post-acquisition profit or loss is a change in reserve between what the reserve was as at the date you acquired your stake that gave you significant influence or joint control, and your reserve as at the reporting date. And I gave an example. If your reserve that you met as at the point of investing an associate was 10 million, and today the reserve is 25 million, it means your post-acquisition reserve has been the increase of 15 million from 10 to 25, and vice versa if it's a decrease. Now, that is the portion you recognize. In this slide, you might say you recognize a share. A share of that might be, let me say, 20% of, let me say, 30,000 or 30 million. In that light, we say this is 6 million. Okay, that is that. The next one is deduct any amount of dividend received or considered receivable, given that it has been appropriately declared from this associate or joint venture. The essence of this is that as we move on, you are recognizing your share of profit in an associate or joint venture, rather than recognizing a portion of it that was paid out as dividend, which means, like we did in the subsidiary consolidation, you will reverse your dividend income to replace it with your share of profit. And that is what we are trying to do here. Okay, in that case, you deduct. Let us assume that the old dividend paid is 5 million. Paid to all shareholders by the associate or joint venture. Therefore, what do? It is a portion that is due to be wary of how the information is presented. If the information is presented with respect to the fact that 5 million was paid by the associate, it means your percentage there is 1 million. But if the information is presented in such a manner that says the dividend you received from associate is 5 million, you are not finding a percentage, because you can't be receiving on behalf of others. What you have received is solely for you. In that case, you deduct 5 million. Okay. Peradventure, the investment in associate is equally a financial asset, is equally an asset alike that have to be subjected to impairment. Even though before you recognize impairment on equity, it must be much more of permanent in nature, and it's much more of such that is not classified at fair value to profit or loss, to which fair value loss will have been taken as a surrogate for such an impairment loss, which means impairment loss to be recognized on equity must be of a permanent nature, or because by the provision of IFRS 9, such impairment loss on equity can never be reversed. Can never be reversed. Impairment loss recognized on equity is always presumed to be of a permanent nature, no matter how subsequently the condition of that asset or of that investment resuscitates. Therefore, if there's any impairment loss on investment in associates or joint venture, such will be deducted. Now, there might now be other adjustments. Other what? Adjustments associated with holding investments in associates or joint venture. And we're going to consider this other adjustment as we move on. And if there's any, it could be positive, it could be negative. This is plus or minus. Thereafter, what you obtain by summing this up is what we call the carrying amount. It's what we call the what? The carrying amount of investment in associates or a joint what? Venture. This is the primary basis to which we do what we do. Any question before I forge ahead? Any question or contribution? And Madam Grace?
Hello, sir.
Yeah?
Yeah, I just have a little worry about something that you said about investment in equity instruments, that whenever it suffers impairment is always of a permanent nature and will not reverse. You know, I know this might be this is the position of the standard, but you know, it worries me um, as to how the reasonability of it. For instance, if an equity instrument suffers impairment, that means it diminishes in value, which also means that the value could also rise in the nearest future. So how come when it suffers impairment is of a permanent nature?
Okay, I will explain. First, equity is not meant to be carried at cost. You agree?
Yes, sir.
And equity by default is to be measured at all times at fair value.
Yes.
And primarily, except otherwise, where you have elected by way of irrevocable right of election, you will have recognized that all equity investment should have been measured at fair value to profits or loss. I will say equity investment or any form of investment measured at fair value to profit or loss should not be subjected to impairment test. And we explain why. Who can tell me why? Who can remind me why?
I think because they are already carried at fair value.
And the fair value loss, which has impacted profit or loss, has more or less built in that such passive impairment. And because impairment is not a permanent loss in its real sense, therefore, likewise, fair value loss is not a permanent loss. The dry bone could rise again. You can say now. And therefore, For you to subject equity investment to impairment loss, it means one, this is not equity investment that is measured at fair value, because it's measured at equity method, because the fair value will not impact our equity valuation here. And therefore, that loss is a loss on equity investment that is deemed to have been carried at cost or equity value other than at fair value. And such, even where there's an impairment assessment, if you believe that it's not of a permanent nature, you are not required to recognize it. But if it's of a permanent nature, you go ahead to recognizing it, and take note, such can never, ever, no matter the condition, be reversed, which is synonymous to not being able to reverse any impairment loss on goodwill. Does that make sense? Take note, the fair value we are talking about here is only the fair value at the date of acquisition. Even if the equity in your own separate financial statement, you have measured it at fair value, such fair value will always be reversed when we are trying to do equity method, because everything must come back to cost. Which means that if, for example, this was not cost, the company always fair value in a separate financial statement is equity investment in the separate financial statement, not in the consolidated. Therefore, what we obtain from the balance sheet of the company is the fair value of its equity investment in an associate or joint venture. Let's say it has been fair valued over time to 104. Now, instead of me recognizing 104, the first adjustment I'll do is to reverse the fair value gain on the investments. I must do that. And what is fair value gain? The difference between the 100 million that was the original fair value, which is the cost, and the new fair value, which is 104, which means I must take away this difference between 104 and 100,000, which was initial cost. And that is how doing so would bring me back to this. Which means at every point in time, this must always be the cost, which is the original fair value, which approximates the cost as at the date of what? Acquisition. This was fair value as at the reporting what? Date, which is now. Does it make sense? At every point in time, even if it's a fair value loss, you will still reverse it. You can say now. And that is what I've recognized it. Now, in practice, subsequently, if this is year one, let's say in practice, this is year one. When we get to year two, you don't start from the beginning at every point in time. Year two will now be the balance as at beginning of the year, which is, let me say 2020. Let me put this one as 2019. Therefore, it will be closing balance for last year plus share of, you don't need to be emphasizing post here because that current year, everything is post. You don't need to emphasize, you now say share of profit or what? Or loss. Which means the current year profit or loss is what you share. And let's say the current profit or loss is 6 million. Dividend for the current year, which is not cumulative. Probably the dividend paid in the current year is just 1 million. Therefore, 20% of it. Impairment loss in the year, let's say just 250, if any. An adjustment, let's say, is now minus 80. At the end of the day, this will not be as at the current year. Does it make sense now? Which means we are saying the same thing. Any question to this? Any question? I want your participation. Now, let me give you a clue on something. Accounting for investment in an associate or joint venture under different circumstances Now, what are the circumstances? A, in the separate financial statements of an investor. B, in the consolidated financial statements of an investor. And C, in the individual financial statements of an investor, what is unique between individual, separate, and consolidated? Who will assist me with this first? I'll use different colors to signify them. Who can tell me the difference between separate, consolidated, and individual financial statements of an investor?
I can give you a try.
Okay.
Okay, let's start from the first one. The separate financial statement of an investor. That is a financial statement of the company without any intercompany adjustments. And the second one, which is a consolidated financial statement, is a financial statement of the group that consists of the parents and the subsidiary. While the individual financial statement of an investor is the financial statements of both the parents and the subsidiaries, or the subsidiary as the case may be, separately without consolidation. Or do you want me to go over it again? You are muted, sir.
Maybe you can clarify yourself better, because take note, the word is that I'm asking you this question only from the perspective of an investor. In this, what is the separate financial statement of an investor? What is the consolidated financial statement of an investor? And what is the individual financial statement, or what we call the financial statement of an investor? Only from the perspective of an investor.
Okay, it's all right. The separate financial statement of an investor is as required by the provision of the standard, and which have not, to which there is no intercompany adjustments or intercompany, how do I want to put it? Okay, for which there's no intercompany adjustments. It's just as it is. For instance, now, maybe there is a loan from the investor to the investee, which ordinarily should be removed on consolidation. That will not be the case in separate financial statements. But for consolidated financial statement of an investor, especially if the investor is the parent, then it consists of both the financial statement of the parents and that of the subsidiary. But in the sake of individual financial statements of an investor, I think this third one is a little bit tricky for me. I don't know how to explain it.
Okay, who will assist Shegun? Who will assist Shegun?
Okay, let me say something. Let me try. For the separate financial statements of an investor, I think it is presentation of financial statements for both parents and subsidiary side by side as if the acquisition has not taken place. That is separate financial statements of an investor. But for the consolidated financial statements of an investor, that is the presentation of financial statements in a consolidated form as if the acquisition has taken place, meaning that the parent and subsidiary relationship is existing. That's for consolidated financial statement of an investor. But for the individual financial statement of an investor, that is presentation of investor statements in a single, just like a single entity. That is my own understanding.
Okay, who else? And
I did, excuse me. Please, what was the question? I'm trying to interpret what is on the screen.
okay, the question is very simple.
Hello?
What distinguishes separate financial statement of an investor from consolidated financial statement of an investor from the financial statement or individual financial?
The line is breaking. I only had the distinguish the investor.
I don't know. The question is for you to distinguish between the financial statement of an investor away from consolidated financial statement of an investor and away from individual financial statement of an investor.
Okay, that's in the case of having an investment.
Okay, now let's go back to it. Your network is breaking. Let me now break the ice. Separate financial statements only is required or only refers to the financial statement of an entity that is a parent entity that produces a separate account other than its account by way of consolidation. Now, better put now, if you're a parent entity that has a subsidiary and you consolidate the account of subsidiary, which means you have a group account, you having your own financial statements separate from the group account is what we call the separate financial statement, which means it's only a parent where such a separate financial separate from the consolidated. Now, consolidated financial statement is a combined financial statement of the parent and all of the subsidiaries as if it's of a single entity. While individual financial statement deals with a company that is just a standalone, is not a parent to any company, it's just on its own. It doesn't have a subsidiary, that talk less of even consolidation, which means a company that is a standalone, which has no subsidiary that will require consolidation as its own financial statement described in this slide to be individual financial statement, or simply put, financial statements. Consolidated financial statements as is financial statement. The essence of that is where a parent entity that has investment either in associate, joint venture, or subsidiary can account for such equity investment as cost, account for it at cost, or preferably account for it in line with IFRS 9, which is at fair value, which means in the individual financials, in the separate financial statement, they account for equity investment in associates, joint venture, and subsidiaries at cost in line with IAS 27 or at fair value in line with IFRS 9, which means what I'm trying to explain here is this. If you are a parent entity who also serves as an investor in an associate or joint venture, in your own separate financial statements, not in the consolidated now, you have the option of accounting for it at cost. And this is based on the exception as detailed under IAS 27. Or you account for it at fair value, which is in line with IFRS 9. Whereas in consolidated accounts, compulsorily, the only method applicable is the equity method. Why? If you are not a parent company, which means you can't even come across consolidated at all. Likewise, can you say that this is a separate financial statement? Because separate from what? You have no other financial statement you prepare. Therefore, there's nothing separate about it, which means in that case, you see it as your financial statement. And in that light, you must use what? Equity method. Which means the only exception to the use of equity method is on the premise that you have a separate financial statement where you can make use of cost or fair value. And the reason why the standard says so is that because this entity will compulsorily still present an account called the consolidated financial statement, which will have taken care of such accounting by way of equity method. And that is that. And that is what I tend to more or less intensify effort towards explaining. Any question before we move further? Now let's see how the standard define in IAS 27 and IFRS 10 what is separate financial statement and what is consolidated. Who can read this for me? What is consolidated financial statement and what is separate financial statement?
Okay. Consolidated financial statements. Financial statements of a group in which the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries are presented as those of a single economic entity. Separate financial statements. Financial statements presented by a parent, that is an investor with control of a subsidiary, an investor with joint control of or significant influence over an investee, in which the investments are accounted for at cost or in accordance with IFRS 9 financial instruments.
Which is what speaks to the fact of measurement either at cost, which is in line with IAS 27, or fair value, which is in line with IFRS 9. And I think that also speaks to the fact here. Can you read this for me? Preparation of separate financial statements.
Okay, preparation of separate financial statements. Requirement for separate financial statements. IAS 27 does not mandate which entities produce separate financial statements available for public use. It applies when an entity prepares separate financial statements that comply with International Financial Reporting Standards, IAS 27. Financial statements in which the equity method is applied are not separate financial statements.
Can you see the reason why I said under separate financial statement, the only options available are cost and fair value? Continue.
Okay, similarly, the financial statements of an equity that does not have subsidiary, associate, or joint ventures interest in a joint venture are not separate financial statements.
Now, can you see the reason why I said individual financial statement or separate financial statement is of an entity that is just on its own? It has no subsidiary, nothing. Therefore, it's not even thinking of consolidation. Where will it come from? It's like saying Fipodomi doing Finance Professional Services Limited now is thinking of separate. What separate? In that light, it doesn't even have a subsidiary that will have said, okay, I'll consolidate. Therefore, what is separate in your financial statement? That simply is your own financial statement as you case it. Continue.
Okay, an investment entity that is required throughout the current period and all comparative periods presented to apply the exception to consolidation for all of its subsidiaries in accordance with IFRS 10 consolidated financial statements, present separate financial statements as its only financial statement, IAS 27. Note, the investment entity consideration exemption was introduced into IFRS 10 by investment entities issued on 31st October 2012 and effective for annual periods beginning on or after 1st January 2014. Choice of accounting method. When an entity prepares separate financial statements, investments in subsidiaries, associates, and jointly controlled entities are accounted for either at cost or in accordance with IFRS 9 financial instruments or IAS 39 financial instruments recognition and measurements for entities that have not yet adopted IFRS 9, or using the equity method as described in IAS 28, investments in associates and joint ventures.
Now, that takes us back to where we're coming from, which is what makes me simplify this for you, so that no thinking is further required to understand what methodology applies when you are more or less construing what accounting methodology is most appropriate for depicting your investment in an associate or your interest in a jointly controlled entity, which we call the joint venture. Any other question before we move ahead? Remember, this is the methodology where you don't fair value it subsequently, which means you only adopt costs, you don't fair value it subsequently. And when you fair value it subsequently, you always reverse that fair value gain or loss before you proceed in your equity accounting, thereby always resorting back to this cost of equity, which is what you have here and what you have here. Let me put color to signify them. Okay, and in the real life sense, how do you do it on a year-on-year basis? This is year 2, this is year 2, this is year 1. Okay. And that is that. Any question? Now let's look at practical illustrations. Okay, before practical illustration, okay, let me show you practical illustration before I'll come back to some critical discussions there. Now, can somebody read this question and tell me the most appropriate way of answering this question? Illustration 1 here. Who will volunteer to read? Who will read?
Okay, let me read it. Illustration 1. For Amola PLC, which with subsidiaries acquire 50 million shares of the 200 million shares in Excellent Limited for 55 million naira on January 1st, 2016. In the year to 31st December 2016, Excel earns profit. I think that should be Excellent Limited earns profit after tax of 20 million, from which it declared and paid a dividend of 10 million as at the reporting date. How should Framola PLC account for the investment in it? A, separate financial statement as at 31st December 2016, and B, consolidated financial statement as at 31st December 2016.
Okay, who will guide us? Who has decided to answer it for us? What should we do? Who will attempt it? Who will attempt it, please? Who will volunteer? I can't hear anybody's voice or any hands being raised.
Okay, let me just try. So this is a joint venture, because you can see that, okay, sorry, I need to look at it very well. Okay, we first need to know the percentage holding, and since this is 50 million shares of 200 million, that is more likely 25% of Excellence Limited shares. So this is investment in associates. So, and based on the earlier explanation, separate financial statement of an investor, so it will be recognized at either cost or fair value. But we are given the okay, we are given the cost of the acquisition, which is 55 million naira. And that is what will be recognized in the financial statements, in the separate financial statement. But when we talk about the consolidated financial statement, we are going to use the equity methodology. And that is, we are first going to recognize the fair value of the investments of 55 million naira. And we are going to add to it the share of profits based on the percentage shareholding. And we are going to deduct from it the 10 million naira dividend to arrive at the amount we are going to recognize in our balance sheet as the value of the investment in subsidiary.
Okay, the total number of shares acquired is 50 million. And the total number of shares in all is 200 million. Therefore, what is the percentage? The percentage holdings. The percentage holdings is what? Is the ratio of what you acquired over the total available. That's 25%. This 25%, what does that signify? Who can answer that?
Is an investment in associates.
Yeah, since there's no other information other than what we have here, it then signifies that 25% falls within the range of 20 and 50. Hence, the investment in XLM can be considered to have given rise to a significant influence. Hence, this makes excellent and associates to Faramola. And therefore, that's the conclusion we've made there. Does that answer it now? Okay. In that case, how do you account for investment in associates in the separate financial statement based on available information? Who will answer?
Yeah, I said something the other time. I don't know whether it's correct or not. I said it will be recognized at the costs of the investment, which is 55 million.
Right? We don't even have information about fair value. And if we have both information, we now have to resort to the accounting policy of the group, which will pick either of the two. In this case, it's 50 million. Thank you.
It's 55.
Sorry, 55 million. Yeah, thank you. Okay, what next? In the consolidated financial statement, what will be our value? What methodology are we adopting here?
We are adopting the equity methodology.
Equity method, thank you. And to use the equity method, we needed the costs, which is the 50 million, 55 million. And we add to that the share of post-acquisition profits. What is the share? 25% is at stake. Post-acquisition profit is, yeah, okay, this is our first year, in 2016 that we have it, and therefore the whole of that profit for that year is 20 million. Therefore, invariably, 25% of 20 million is how much?
5 million.
5 million. If it's lost, it will be negative. $5 million. Off we go in what? In thousands. Okay, now thereafter, what do we have? There's no information about dividend. There's no, okay, there's dividend.
Sorry.
Deduct, yeah.
Yeah, associates profits is 20 million. I think that post-acquisition profits where we put 5,000. I expect us to put 20 million and the 25% will be 5,000.
Okay, thank you. It's 20 million, yeah. Now, deduct dividend received or receivable in this case. Now, in this case, because I've told you, information was given to us from the perspective of the associates, that the associate declared and paid dividend of 10 million, which means your own entitlement there will be 25%. It's quite different from when they tell us that dividend you receive from asset is 10 million. In this case, I have to deduct 25% of that. Dividend declared and paid. Our figure in thousands. Okay, no impairment loss. And this is what we'll recognize in our books. Now, what will have been the accounting entries? The accounting entries will have been as follows to recognize all what you have done. One, debit for the share of profit, you debit investment in associates or JV. And credit profits, which invariably will go into consolidated reserve or retain what? Earnings. Okay. How much is that? It's with the share of profit. If it's share of loss, reverse will be the case. And with the share of post-acquisition profits in the investee, which is either associate B, B, for the dividend, reverse will be the case rather debit the group profit by reversing, because what you are simply doing is you are reversing. And that reversal means you are reducing the value of the investment also. That's why we're crediting the investment in associates. By how much? By that 2.5 million. Okay, let me describe it. This is reversal, and this is recognition of share of profits. And that is that, yeah. A is recognition of share of profits in an associate or joint venture. This is recognition of the reversal of dividend income. And we are reversing because the income and the profit, share profit are substituted for that in the associate or joint venture. Okay, now let's see who can solve, who will guide us in the second one. Who can read the second question? Somebody should proceed to read the second question.
It's not showing yet.
Okay. Okay, let me copy it for you then. Okay. Who will solve this? Can somebody read the question now?
I'll read. Lily PLC, a company with a subsidiary, acquires 50 mineral shares in Zoe Limited for 120 million on 1st January 2016, December 2016. Zoe Limited earns tax expense of 12 million of the dividend declared and paid to Zoe Limited in the financial year. The sum of 5 million represents what was received by Lily as a return for investment in Zoe Limited. Required advice on how Zoe Limited results should be accounted for in the separate and consolidated financial statements of Lily PLC for the year ended 31st December 2016.
Okay. Okay. Who will guide us now in this question? Who will guide us? Who will guide us? I need somebody to guide us.
Okay, let me just say, based on okay. Okay. The question, I can't see the question again. Okay, sorry, I've seen it. Illustration 2. So basically, we are supposed to account for it in a separate financial statement as sorry, just a minute.
Can I try, sir?
Okay, well.
All right. The difference I can see.
The network is
from this one, and the first question we solve is that this one has a tax expense before tax. So, hello?
Hello?
Can you hear me, sir?
Yeah, I can hear you. Before the network was broken.
Okay. I said my observation between this question and the first question is that in this second question, the profit before tax is 60 million and tax expense is 12 million. So the distributable out of which they can pay dividend is 48 million. So we will compute the profit as 25 profits to Lily dividend. We find 25% of the dividend, and that one is deductible from the profit sharing. That's my
Okay,
understanding.
any other person?
And
Thank you, ma'am. Any other person?
Yes, in addition to what she has said, we've already been given the dividend of 5 million. So out of the dividend
Any other
declared,
person?
yes, I'm trying to say something,
Okay.
sir.
Yeah, go ahead.
So I'm saying that Lily PLC has been, no, the sum of 5 million naira represents what was received by Lily PLC. So when deducting our dividend, we are going to deduct this 5 million naira, and we don't need to start computing for dividend again by multiplying the percentage holding with the dividend declared. So the dividend received had already been given to us on a platter of gold.
Okay, that's one. That means in this case, they said of the dividend declared and paid by Zoe Limited in the financial year, the sum of 5 million represent what was received by Lily as return from investment in Zoe, which means you are not going to be looking for percentage. That's one. Two, how do you address the aspect of giving us profit before tax and giving us income tax? How do we treat that?
Okay, in the aspect of uh, profits before tax of 60 million and income tax expense of 12 million. Before we consider share of post-acquisition profits, we are going to remove the tax expense of 12 million from the profits before tax before we share the profits between the associates. And another thing, I have a concern with this requirement, with the requirements of this question. And my concern is this. Lily is an investor, but the requirements stated that we should advise on how Zoe Limited results should be accounted for. Are we accounting for investees' shares or investor? Because I think it should be advised on how Lily PLC results should be accounted for. That's from my own perspective.
I think you didn't read the question well. It says advice on how Zoe Limited results. These are results of Zoe Limited. How will it be accounted for in the separate and consolidated financial statement of the investor? Lily?
Okay.
Did you get the message clearly? These are the results of Lily, investee, Zoe. And we are
Zoe,
saying that
exactly.
how will you account for the result of in your own financial statement as an investor?
Okay. I get it clearly now.
Okay. Now, number of shares held by Lily is 50 million shares out of the 200 million shares in Zoe. That is still 25%. Okay, that gave us some kind of influence, and therefore it makes Zoe, in this case, to be associate of Lily. Now, in this case,
The shared working paper.
Okay. That is it. In this case, how will you account for this investment in the separate financial statement? It's still at cost. but the cost now is 120 million. Okay, what is our post-acquisition profits? Our post-acquisition profit, given that that investment was made on 1st of January 2016, was the difference between I'll take that up. I have profits before taxes and have income tax expense. And how much is that? I have 60 million and I have 12 million as income tax. Therefore, it means my post-acquisition will be net of tax. I think that's what Newton said there. This to be net of what? Net of taxes. Take notes. Okay, what matters to us now is that we are recording 25% of 48 million. Okay, and that is 12 million from our formula here. And dividend, the amount of dividend received now is not declared or paid to us, but actual amount received was 5 million. And therefore, in that case, you are not looking for any percentage. You are going to recognize your 5 million directly as a deduction. And that gives us what we do with respect to our accounting what? Entry. Any question? Any question?
And add share of post-acquisition profit. Okay.
What is it? Okay, now at this point, you will go on with this assessment as we wrap up in part 2 of this section. Now try to demonstrate understanding of all what we have discussed with respect to investment assets and joint venture by solving this balance sheet question, where we have Pali to be the parent to Susie. Susie is the subsidiary to Pali, and Pali is an investor in Mama, where Mama is somewhat an associate to Pali. How do we proceed in consolidating? And consolidating is that of Pali and Susie, and equity accounting for the investment of the group in Mama. That's the first assessment or assignment, as the case may be. second one is what I'm trying to do up now, which I'll give to you. The second question will be this, which is the aspect of profit or loss. Try to attempt this. These are the two we'll first of all look at before we look at other ones, but this must be attempted by you guys before we continue with our part 2 of the section tomorrow. Thank you very much, and God bless you. If there's any question, feel free to ask. If none, thank you for today's lecture, and God bless you guys.